Do you know loan is the biggest scam in this world? Let's try to understand it. In this video, we'll also try to understand how loans can be a biggest drawback for some businesses, and for others, loan is a money making machine. In the most cases, if you took out loan, then you are not working for yourself. You are working for the banks or the lenders. Because if we analyze average business profit, then we will realize that normally businesses are making 10 to 15% profit, and the bank interest rate is also around 10 to 15%. That means you are only making profit from your capital contribution, because the rest of your business profit goes for interest payments. But loan comes with some other liabilities as well, like processing fees, renewal fees, and many other fees that makes your business less profitable in net. But due to business slowdown or economic slowdown or because of some pandemic, if your business will not cover the interest payment for some times, then you have to work rest of your life just to pay your loans. Now the question arises, if loan is that bad for business, then how big businesses and big corporate house have millions and billions of loans and still in profit? If you will study their financial information, you will get to know that normally they have more cash reserves than their loans. If they have more cash reserve than their loans, then why they are not settling their loans, you ask? The simple answer is to avoid tax. Let me give you a simple example. Suppose this is the balance sheet of XYZ Limited. Here we can see it has 1 crore of capital, 2 crores of free reserves, and 2 crores of loan. And if the company wants, it can pay their loan very easily because they have 2 crores cash left in their balance sheet. But they are continuing their loans to take tax advantage. Let's see how. In income statement of XYZ Limited, we can see it has 4 crores of sales and the gross profit margin is 15%, so the gross profit is 60 lakhs. It has 2 crores of loan in 12% interest, so the interest expenses is 24 lakhs. And because of interest expenses, company only have to pay 1,62,500 as a tax. But if it has no loans, then XYZ Limited has to pay 7,62,500 as tax. So because of loan, company saves 6 lakhs tax. If we will adjust this 6 lakhs on interest rate, then the interest rate will become 9% because of the tax saving. Now we can say that for XYZ Limited, 12% interest rate become 9% because of tax adjustment. Loan becomes cheaper for XYZ Limited. Now that loan can be used for merger, acquisition or business expansion. Even 9% interest can be earned by investing in government bonds or fixed deposits. That was a very simple calculation to make you understand, but in the practical world, there are many other ways big businesses and corporate house utilizing loans to take tax advantage and making it cash cow. If you have loan in the business, balance sheet size increases, and that shows bigger business than actual. That attracts investors. This is also the advantage of loans. Taking loan can be a good decision, but only if you can properly utilize it and can make much more profit than what you pay for that loan. Now let's try to understand how loans is the most profitable product or money making machine from banks point of view, and how banks are creating digital money out of loans. There are only around 3% physical money in the economy, including paper money and coins, and the another 97% money is created by debts or loans. Whenever bank gives loans, they are not using their physical money. They just type the number in their system, which did not exist before. Banks created that money out of nowhere, which is also popularly known as out of thin airs. And when you pay that loans, the principal amount gets removed from the system, but the interest income and other fees remain in the system, and that is how new money gets created, which leads inflation. Another, whenever the government needs money, they go to central bank and take out a loan. The central bank gives them money created in the same way out of thin air in the exchange of government bonds. Again, when government pay that loan from their tax income or by increasing tax rate, then that digitally created money by central bank get adjusted, but only principal amount vanishes from the system, but interest income remain in the system, and the principal amount also remain in the system for a long time until it gets settled. And that is how digital money is created out of nowhere. This newly created money floods the system, and the more money in the system means the existing money is worth a little less, and that is called inflation. You are working too hard to save up money, and banks are printing more and more money and making your saving worth less and less. Banks are making millions as interest income from digitally created money out of thin air and making our hard-earned money less valuable. This is why to make money it is very important to know that how to take advantage of debts and not to put ourselves in a debt traps that I will cover in the next part. Of course, many central banks put limitation on creation of digital money for commercial banks by issuing policies and regulation for capital deposit loans requirement ratios. But if we dive deep into banking system, we can see that manipulation is being done everywhere. And another thing is there is no bar for central bank for creating a digital money out of thin air. The only thing is stopping them to go slow is inflation.